Good afternoon, everyone. I'm glad you could join the session this afternoon, Building the Ultimate GL. Today's presenter is going to be John Smith, who is Director of SMB Global Business Applications and project sponsor. He leads the SMB business unit of Acquisitive and joined the company in 2003. His career spans finance and human resources, including 2 decades of consulting experience. John's a CPA and CMA. And John, looking forward to your insights this afternoon. Take it away.
All right, thank you, Marion, and good afternoon, everybody. Thank you for spending a little bit of time with me today on this session on, I guess, creating the ultimate GL or COA. And, you know, this one I've done many, many times over the last 20 years. We've done them at, you know, GPUG events. We've done them at Connections events in the past. And, you know, it's really strange. We're doing all these new implementations, and we keep coming back to the same core principles that are in this presentation, which is that in these ERP systems, your chart of accounts is actually the most important fundamental structural element. You know, as 15 years ago when I was learning GP, I bought this book called GP for Dummies, and the first page said, and I'll never forget it, all paths lead to the GL. Yeah, and you know what? Nothing's changed since then. So we're going to spend some time today, I think, with some best practice advice on the chart of accounts, and I think this is relevant whether you're using GP, whether you're using SL, or, and maybe really importantly, if you're thinking of doing a migration to the cloud, like I would actually recommend clean up the chart of accounts now, don't wait, but we'll talk about how we do all of that and give you some advice and tips. So let's just talk about, you know, where the problems appear. You know, we all know this stuff, right? We've got financial management reporting. It's not clean. We got to do a bunch of back-ended maneuvers in Excel. We got to, you know, put data together in some weird way to get reports out. We got a lack of consistency across entities. We've got consolidation issues. We've got errors and reclass entries because people don't understand the chart of accounts and book things to the wrong account. We got a budgeting and planning system that doesn't work and it's never been loaded. Too many GL accounts. Boy, I could talk about that one. The first business trip I ever did 20 years ago. Listen, I went to Winter Haven, Florida, and, you know, we went to a clinic there, and they had physicians, and they had created, for every physician in the hospital, they'd created a segment in their GL so they could run a P&L by physician. They had 240,000 general ledger accounts in GP, and it was, you know, having trouble posting. Was slow, and we went in there and did a changer exercise to clean it up. So, you know, this happens, right? You just have too many GL accounts. People have created them, and it explodes, and it seems out of control. Integrations keep breaking because chart of accounts keeps changing, and, you know, we're getting exceptions, and things aren't posting. So there's a lot of reasons why we have a need to look at our chart of accounts and clean it up, right? And if you think about the chart of accounts, right, I spend a lot of time thinking about this, like why do we have problems with it? And it could be a lack of training. I actually think, you know, surprisingly, in accounting school, we don't spend a lot of time talking about how to create the correct chart of accounts. We inherit a chart of accounts that somebody else created. We got a new implementation that used legacy. Oh, I hate that, but that happens. No one thought about the reporting when the original chart of accounts was created, and now there's a disconnect between organizational reporting needs and what the COA has. You know, there's no guidebook or rule to follow about when we create a new account, so it's a free-for-all. Somebody in some department says they need an account, so we create one, and then we're stuck with the baggage of it for life because there's history in there, right? Org structures change like the wind, and we need new charts of accounts. So, you know, all of this stuff contributes to the issue. When we go in and do these exercises, and we've done them many, many times, we've done chart of account cleanup exercises, we continue to do them. You know, the clients are usually looking for some desired outcomes. One is consistency, right, across entities and business units, ease of consolidation, you know, benchmarking, yeah, that's important. I'd say that's reporting as well. Reduced learning curve is a big one, like make it simple so people understand it. Less time on reconciliation, built-in flexibility for growth. And that leads to number 7, structure, right? Those two, the flexibility to grow and the structure of it are really important considerations if you're thinking of doing a migration at any point in the future. You know, chart of accounts is something to think about right now. It's probably a good idea. because you can take advantage of some migration tools and stuff, and they work better if the chart of accounts is clean and you know what you have in the current environment is what you want to move into the future. So there's a little benefit there thinking about that now. You know, the single biggest thing here is that reporting and analytics, and I see this one a lot. I think this is a legacy issue from prior generation product and training, where we often see the GL being used as the end-all be-all for all reporting, right? To the point where the GL gets overburdened with detail and segments and dimensions because people look at it like it's the sole way to do reporting. And when we do implementations, we talk about a paradigm shift that we ask accountants to make, which is to think that, you know, you get a lot of reporting and robustness of reporting out of subledger data. So, you know, we've had this discussion with clients in the past. Don't put salespeople in the GL. Go look at the sales subledger, look at the sales transactions, and run a report on the sales transaction by salesperson. We don't need that in the GL, right? And so there is a mistake that gets made there where we do too much. We try to do too much in the GL, and I think you gotta balance this a bit when we're doing it. So one way you can do this, right, is to create a chart of accounts handbook, right? So, and I got an example I'm going to show you here in a minute of an actual handbook. I was from a client many years ago, and I took their name out of it and stuff, but and changed some things, but disguised it. But it's a really good idea to have a chart of accounts handbook. So if you say, you know, people tell me, oh, I got a great chart of accounts, right? I'm like, okay, good. Do you have a handbook? They look at me like I've got 3 heads. And, you know, a chart of accounts handbook is just a guide that tells people in the organization who have to touch GL accounts what they're for and which one to use for what purpose, right? It is actually very useful when we're doing budgeting and planning and rolling out products that depend on that chart of accounts. It could be employee expenses, it could be, you know, an AP automation project, it could be reporting tools, it could be budgeting and forecasting. So the handbook is a great idea. It lets accounting say no when someone says, I want a new GL account. I love that. Say no. If you have a good tight GL account structure, somebody asks you for a new one, say no. Like, read the handbook, post it to that account, right? And that'll stop the proliferation of growing accounts. Right now, it's tough to do if the CFO says to you, hey, I want a new account. You're like, hey, no, here's the handbook, you know, go use it. But you get what I mean, right? And I think this is a really important thing we can think about. I remember early in my career, I started at a Fortune 500 company in consumer goods, and there was somebody in charge of the corporate GL. Now, mind you, it's Fortune 500, it's a multi-billion-dollar organization, right? And I remember making the mistake one day of going up to corporate finance and saying, hey, manufacturing needs this new account. And the lady literally like slammed her hand on the desk and said, no new accounts ever. I never create new accounts. Here's the handbook. And since that day, I've thought, yeah, that's pretty good. You know, that's one way to control the chart of accounts. All right, so let's go take a look at how we figure out what we want to do, right? It starts with, you know, assessing your chart of accounts and doing some analysis and review. And honestly, it starts with looking at the reports you have and the financial reports you have and the ones you want to generate, taking stock of what's there, looking at how they're created and seeing how much manual intervention is required to push out reports, right? And then figuring out what you need going forward, ultimately preparing a gap list to say, here's where we want to be, you know, this is what we have, here's the issues with the chart of accounts that may be causing problems getting us to where we want to go. And then we look at the structural elements of the product, right? So, you know, if you think about all the Microsoft products, it doesn't, whether it's GPSL, whether it's the new guys Business Central, or, you know, our finance and operations product on the enterprise level, we have this same discussion across all of them that says we got to look at in GP you'd call it multi-segment, right? And then and in the other products that you look at, you call it a segment and a dimension. Doesn't matter. They're just building blocks of the chart of accounts. And what we have to look at is how many core building blocks should we have in the chart of accounts, right? In the case of GP, as the GP users on the call know, you can put a maximum of 10 in there. That would be a terrible idea. We have worked with a client that did max at 10. They lasted about 1.5 years. There was all kinds of issues and errors, and we had to go back and run changer to bring it back together. But the chart of accounts lets you harness more than just the segments, and true of all of the Microsoft products, right? That what we have in there is we have an account, segment, or dimension, but we also have things like categories and user-defined fields. In the case of GP, it's got analytical accounting that can help you broaden the data set. So I'm not going to get so concerned today about where we put that as much as to say that we just need to figure out the core things we need to track to model the business or the organization as it may be for reporting purposes. Okay, and usually what we'll, just back to this, I mean, usually what we'll do is we'll see 3 or 4 core reporting dimensions, maybe 5. 10 would be too many. We put some stuff in here for the GP, on the GP stuff. This is the, again, all the products have this, but here we're looking at one where we got 3 segments: division, account, department. And all we're pointing out here is on the account primary record. Not only do you have the number and the description, you got things like posting type, you've got user-defined fields, and you can use this stuff for reporting. So it doesn't have to be just, hey, a number and a description. Let's think about the category. Let's think about the user-defined fields that are here as well. In GP's case, there's analytical accounting, which is something else we can think about. And when you get into the reporting tools, whether it's Management Reporter, whether it's FRX, whether it's Financial Reporter in Business Central, or whether it's Management Reporter in F&O, it all comes back to that these tools support the segments and dimensions you put into the structure. And so in GP, Management Reporter is going to pick up your segments, but it's also going to pick up your analytical accounting dimensions. So when you start thinking about it, then, like, what's the right blend or the best practice that's out there for the chart of accounts, right? Usually 5 as max is the big takeaway here. 5 dimensions or segments, and you're always going to have a main segment in any of our products. There's a main segment, right? The main segments like cash, AR, payables, equity, sales, cost of goods sold, core operating expenses, salaries and benefits, rent, office supplies, etc. That designates your main segment. So you're always going to have one there. We know that. Then the question is, how many additional ones should we have in here? My view is 5 max. And I've just lived this for 20 years. I've done all kinds of chart of accounts restructures. As soon as you get beyond that, it becomes cumbersome. It just becomes too hard to remember which ones go with which and which combinations, and there's too many accounts, and people just get confused. Ideal number is somewhere in the 3 to 5 range here. You want to ensure that when you structure it, when we actually come up with the numbering, that we're allowing an opportunity for growth to add more accounts if we have to. But we want to also think, when we get back to that 3 to 5, right, you want to think about the core ones. And when I say core, they would be things that would say, no matter what we do with our business, we're always going to report on main account. We're always going to report on business unit. We're always going to report on department. And then people would say, well, what about project or something? And you say, well, project may or may not be core. It might not stick with us, right? Depends on the year. Maybe we have some projects, but if we don't, we won't use it. Then I don't call that a core segment. A core segment's one that sticks to the ribs. It's going to live with the business. No matter what it's in, we're always going to report. As I said, we're going to report salaries and benefits by business unit and department, right? So there's 3 that I just chose just by talking out loud. And the typical ones you see down here: department, division, business unit, product line, sometimes project. If you're in GP and you're thinking about chart of accounts or analytical accounting, if you're looking at one of the cloud products, which now move on a single primary main account segment and financial dimensions, which should be which, that's a discussion we can have with you. But the bottom line is, the core segments are the ones that stick. Anything that's short term or you might use here and there, in GP's case, that would be analytical accounting, and something like any of the new cloud products, it might be a shortcut dimension that you use once in a while. This is important, right? So, we did a big F&O implementation 1.5 years ago, and the client had a chart of accounts that was completely out of sequence. They had revenue up near the top. They had assets and cash near the bottom of the chart. And I was scratching my head and saying to them, you're going to have trouble, because anytime you look at any examples of training that Microsoft puts out, this is the structure that's used. And the reason Microsoft puts that in there is because that's what they've seen over the year with hundreds of thousands of clients. I consider this best practice. This does fall in line with what's recommended in any accounting literature I read, which is basically to sequence the chart of accounts in liquidity order. So we start with assets, liabilities, equity, we go to revenue, cost of goods sold. Usually 6,000 we typically recommend, that's acquisitive or recommendation I would make, is, you know, put salaries and benefits in their own expense segment there, because it's a huge amount of dollars. Other operating expenses in the 7,000 series, non-operating items in 8,000, and unit accounts or statistical accounts down at the bottom. What does this let you do? Immediately, from a training perspective, everybody can see what, you know, what's required there, and easily understand the sequencing and segmenting of the chart. Next is to think about grouping, right? So say I had divisions and departments. Well, what I could do is eliminate the concept of the division in the chart of account, because I could sequence the departments in a way that they roll up into a division. Anything in the 100s would be G&A, anything in the 200s would be sales and marketing, anything in the 300s would be R&D. I don't need to add a segment 100, 200, 300. I just need to know that the 100s roll up to G&A. And, you know, think about grouping and using that inherent grouping to avoid a segment. What does it look like in real life? All right, so let's take a look at a couple of things here, just very quickly. I'm just going to pull on an example. So the first one was the company handbook, right? The handbook example. So here's a disguised chart of accounts handbook, really well put together, right? And here's what it's doing. You know, it's not only telling the reader what assets are, it tells them the financial statements reference. So if they're looking at a financial statement, right, if they're looking at a balance sheet in this case, and they see cash and cash equivalents as a row on the balance sheet, it's actually telling them what accounts roll up into it and how those accounts are used, right? So you think about this, if somebody's in a budgeting system, or you've got somebody maybe non-finance who's you know, a responsibility center manager who's getting financial statements, they should have something like this, right? Likewise, anybody who's responsible for choosing a GL account should have something like this. So when you get into, let's go into some expenses here, right? We go into expenses, right? Advertising, print, right? Well, in their case, it was revenue from a visitor guide, right? Advertising from the website, self-explanatory. Advertising from the cooperative, you know, promotional participation, how these are trade shows, right? Publications, on-site merchandise, like, you get the idea. The idea is that this guidebook shows people what to do, right? It shows an external person coming in, or a new hire, how we use the accounts. We don't just send them a spreadsheet of GL accounts and say, hey, I hope you can figure this out. Good luck. We're actually giving them some guidance. And so, you know, if you want to get best practice, if you really want to brag about your chart of accounts, I know it'd be a good way to kill a party, but if you want to do that, you need to build something like this. And I think it would be just an awesome idea and a real value add to any business to have a chart of accounts handbook like this one. Okay, I'm going to show you some other things we go through. So, you know, when we look at a chart of accounts, right, and we start spinning through it, right, we see stuff like this. Right, I look at this. This was one from you know, many years ago where we did an implementation. You know, I got to looking at this and I was like, okay, well, like, I got all these 10, 11, 12, 13, 14, 15, 16, 17, 18. I got in 1100s, and then I got petty cash, and then I got cashier stuff. And you know, it was decently structured, but it was a little messy. And so we talk about doing a chart of accounts restructure. When we do cloud migrations and we talk about changing the chart of accounts, we talk about a crosswalk between the old account and the new account. And so what we end up doing here is we end up saying, hey, I'm going to break this down segment by segment. I'm going to take what we have now, and I'm going to make recommendations for a new number, right? And even if you go back here to the very beginning, right, you see all this one after another like this. I don't really like that. what we want to do is create room between the accounts so that if you have to stick a new one in, you can do that. You've got a number between them, right? You've got availability to put a new one in. And so, that's a very simple example, but we would go through the whole chart of accounts and do a crosswalk like this, follow the guidance of the 1, 2, 3s, and come up with a new one. And inevitably, we end up with, hey, here's what the new departments and products and locations are going to look like. And, then we'll do some mapping to the old and new and come up with a new chart of accounts. And so this exercise is something that we do on all the migrations we're doing, but we also do chart of accounts restructuring exercises with our existing GP and SL clients. And again, I think it's something that you immediately get a benefit from better automated reporting, as well as, getting ready down the road. If you're thinking about a cloud migration, you can have a really nice structured set there. In the case of, let's say, let me zoom in on this one for you for a second. In the case of like Business Central, we actually in Business Central now use beginning and ending accounts, right? So when we think about the chart of account structure, we actually think about coming up with a structure that says, in this example, cash starts here on 102 and it ends on 1098, and those are called beginning and end total accounts. You can't post to them, so the posting accounts go in between. So when I go back to what we recommend when we started this, and we go in here and we look at this structure that's here, right? It's always our guidebook. It doesn't matter what system we're in. It's our guidebook to sequence them and to group them in a way that makes sense. So if you're thinking about wanting to do a chart of accounts change in advance, like in your existing systems today in GP or SL, there are tools available to help you with that. In the case of GP, we actually built originally the biggest chart of accounts changer the company did. It was priorly known as CRG before it was acquired by Quisitive. We built Changer, over 20 years ago. It's been used by, 5,000 plus GP clients to change their chart of accounts. I wish we'd put a counter on the number of chart of accounts we'd actually, changed over those last 25 years, because there's got to be tens of millions of accounts, maybe hundreds of millions of accounts that have been changed. It lets you go in and basically reset the chart of accounts. It takes all the history and does it too. So it's like the old chart never existed. For GP, we have Reformatter, and Reformatter allows us to add segments or change the chart of accounts structure. If the structure was set on implementation and it's locked, let's say we want to add characters or add a digit to a segment and we don't have room, Reformatter is going to allow us to do that. And then lastly, I'll just bring up here, there's still this service we're doing for GP clients. It's actually quite popular. It's called Company Combiner. We've done some, I wish I could mention names, I can't. We've done some major sports teams that have set themselves up on GP with like 70 different legal entities for one reason or another, and they say, oh, this is painful. Like we want to bring this monstrosity together and bring it into three entities or something like that. And effectively what Company Combiner does is it lets us pick a legal entity as a parent and essentially bring the other ones in as children. And we do that by setting up a segment in the parent and bringing in all the history data so that after combiners run, you actually are able to get rid of a number of your GP legal entities. So anyways, these tools are here to help with the chart of accounts, and ultimately that's the story on the chart of accounts. We got lots of guidance and advice that we can give you. So if you're thinking about it, reach out to us and we'd be happy to help and happy to offer guidance. And we've got, as you guys probably are aware, a ton of experience doing this. At this point, I'm going to wrap this up. I'll see if there's any questions, and if not, I'm going to pass this back to Marion. Marion, over to you.
And hi, John. Thank you so much for that. Enjoy the rest of your day. Thank you again for attending. Bye-bye.
Thanks, everybody.